Mortgage rates are up, affordability's down, and it feels like homeownership is slipping further and further out of reach. But the question is it really? Or are we just stuck in a loop of fear and false assumption? Here's the thing. So many of you have told us over the years, I'll buy when interest rates drop, or it's just not the right time. But when we dig deeper, it's not just about the mortgage rates. It's the fear of making the wrong move, or in some cases of being pressured, or not knowing what's really possible for you.
Today, we're going to break down, Jeb, what is really keeping buyers on the sidelines. The big headlines are interest rates. It's the obvious thing. It's the easy thing to see. High prices are there. Really comes down to affordability, but we're going to talk about all those things and explain to you who are listening that if now is the time in your life that you've decided it is the right time to buy, whether it's family situation, whether I've reached a point in my career, whether I've reached a point of savings, of how we can navigate the market, of the psychology that is going through buyers' heads right now, because that's really what we're going to talk about, Jeb. We got a lot of really good data, a couple different surveys asking buyers what they think and what's keeping them on the sidelines. And is there some truth? Is there some validity? Is there some real things that you should be thinking about? Absolutely. But there's also some false beliefs, some limiting beliefs that are keeping people out of the market, keeping people from making a decision that they otherwise should be making. So that's really what we're going to go through today.
You said false beliefs, Josh. What are we talking about? What are those false beliefs?
That there is some magical point in the future that we will get at a point where affordability, so lower interest rates, prices, we get people that literally think prices are going to crash and then they're going to buy. I can tell you from experience, if you listen to the show for any period of time, you know that we do not believe there is any chance for a replay of 2008. But going through 2008, I tell you guys all the time, from 2010 to 2013, I was screaming from the mountaintops, buy a house, buy a house. For us in Orange County, California, one of the most expensive markets in the United States, one of the most expensive markets in the world, we could buy a house with 3.5% down FHA and have a lower payment than what it took to rent it at that time. That $300,000 house, that $265,000 house from 2011, 2012 is $900,000 to $1 million today. So we always got to get the caveat here, Jeb, because we have people saying, well, great. So you're telling me I should have bought when I was in 7th grade. No one is saying you should have bought when you were in 7th grade. What we're saying is when you have a big downturn, which is not likely to come, when it does come, no one wanted to buy. People told me I was nuts. Shadow inventory. There's another leg down. This is going to get worse before it gets better. So thousands and thousands of people didn't buy, put it off 4 or 5 years. So what we really want to do is go through the data of the psychology of what's going through people's heads and help you decide what's the right decision for you today.
Yeah, and I think it's important to note this isn't a push to get you to go buy a home. We're talking to the people right now that are ready to buy a home. Right? They have financial stability. They have job stability, relationship stability. They plan to be in the home for the next 5+ years. Those are the people that we're talking to. And I think the idea of the episode here is just to tell you that waiting isn't always the right answer. Could it be? In some cases, if you don't have those pieces of the puzzle that we just talked about. But waiting doesn't necessarily mean more affordable or less prices. It's all about time in the market. And having that time in the market allows for other things to take place, which is really the benefit of real estate. So Josh, surveyed by Maxwell, surveyed 1,000 would-be buyers. And the idea or the question was, what interest rate would make you jump back in the market? And the number one answer was 5.5%. So today, interest rates, we're sitting 6.75-ish. We've been hovering between the 6.5% and 7% for the better part of 2 months. With that, there are people still out there buying, believe it or not. I just sold a home in the very first weekend. It had 40 plus groups of people through in 2 days. So there's still a lot of activity in the market. But this is saying, hey, there's going to be more people coming into the market if and when interest rates drop. So what are your thoughts on that?
I think 5.5 is a really aggressive number. People always ask us, forecasting is a fool's game. It's very, very difficult. I think rates are going lower. Could that be a bias? It could be a bias on my part. But looking at the data, I think the economy is slowing. I think the trend for rates is lower. But to get to a 5.5% interest rate, we need probably in the ballpark of like a 3.25 10-year Treasury, a full percent lower than where we're at right now. With all the uncertainty, all of the headwinds, I don't know that we get there anytime soon. Could we? We absolutely could, but waiting for that being your trigger of when I will jump in is crazy. And what I will say, Jeb, is most folks, that's not an educated number where they've sat down with a mortgage professional, run the numbers and said, okay, at today's prices, okay, I could afford today's prices at 5.5. They're just saying, 5.5 feels okay.
Yeah, it feels good. Well, I think let's talk about why 5.5. Like, why did you need a 3.25, right, Josh? Because you've got a 10-year and a yield spread on top of that, that are combined to get you somewhere in the ballpark of 5.5. So talk about that, because people listening for the first time have no idea why you need to see a 10-year at 3.25 to get a 5.5% rate.
So the 10-year Treasury is it's an index that closely ties to mortgage rates. They don't move in lockstep, but they never get too far from one another. But the 10-year Treasury, that is U.S. government debt of the term that most closely matches mortgages of how long they run before they pay off, refinance, sell the house, whatever. So when we look at that, U.S. government debt is the gold standard anywhere in the world. So if you're looking to buy a bond, it is the safest bond you can buy. So generally going to have the most demand, lowest interest rates. So if we then start looking for yield, if you're an investor saying, well, I don't want that yield, I'm willing to take on a little risk. U.S. mortgage-backed securities are generally very, very safe, but there's a spread. Over time, that spread at the depths of COVID was like 1.25%. So when rates were 3%, you had a 1.5, 1.75 10-year Treasury and like a 1.25, 1.5 spread on top of that. At the worst part of rates spiking in 2022, we had a spread of 3%. Right now, we're 2.3 to 2.4, kind of bouncing around in that range. Normal. Long-term normal, say from 1980 to 2022, was somewhere in the 1.7 to 2% range. So if we get a little lower, we don't need a little lower on the spread. We don't need quite as much of a dip in treasuries. So it's easier to forecast treasuries than what's going to happen in mortgage-backed securities, because mortgage-backed securities are essentially going to follow that 10-year treasury.
No, good stuff. So here's I think what's important. 77% of buyers at the moment say that they're financially ready, but they're watching the market, right? Josh, they're preparing, they're waiting for something to happen to get into the market. So I think it's important to talk about that, because there's this group of buyers sitting there waiting for the perfect opportunity. And that perfect opportunity, while you and I both think mortgage rates are going to move lower, and that home prices are likely going to stay at least at the rate of inflation, 2 to 3%. I mean, kind of on the low side. That means over time, that's going to get more expensive. The price of that home is going to go up. So if it takes 3 years to get back to a 5.5% interest rate, which I don't necessarily think is going to happen, but if you would have asked me 2 years ago where I thought rates would be, I would have definitely said in the fives. Like, I mean, we've been higher for longer, higher than I thought we would be for longer. And at the moment, I don't know. I mean, there's a possibility that we stay there.
Absolutely. For a million different reasons that we won't go into today. But the new normal, if you told me 5 years from now, we settle into a new normal and it's 4.5, okay, I could believe it. If you told me it's 5.5, I could believe it. If you told me we are there right now, I looked at the chart last night, Jeb, after the run up into 2022, with this sideways range in plus or minus 6.5%. We've been a little bit under 6%, a little bit over 7%. I mean, a lot over 7% for a few brief periods. But so for the better part of 2.5 years now, 6.5% is the new normal. So any of those are possible. And what we've seen is a bunch of people were able to jump in, make the leap, decided it was the right time in their life, bought at a higher interest rate, and are now rolling down. We got a listener to the show right now. They bought October of 2023, 7.125%. It's a $700,000 loan. We're doing a no-cost refinance for them now at 6.625. So is it the 5.5 we're talking about here? Are they stoked? Are they going, great, we've reached our end point, we'll never have to worry about this again? No, but it's real money. It's $350 lower a month. And then we're going to look to do it again. Take it rate from 6 1/8 to 6. And then if and when this happens, take the 6% down to 5. Now, if you're looking at buying a home that's $400,000 and you're going to get a $350,000 loan, you probably need a bigger move in interest rates to make it make sense. So it's not as easy as some of these higher priced borrowers being able to take smaller leaps down as we go, but you're also not fighting as big of a payment. I think the big thing, Jeb, that I find is that people think in big terms and they don't do the research until they get closer to those broad stroke ideas they have. So 5.5. Okay, maybe rates get to 6%. That person actually steps out and goes, okay, I'm going to call Josh. I'm going to go through the numbers. And we sit down and they go, really? I could have done this a year ago. And we also have people on the flip side, Jeb. I don't want to make it sound like, hey, everyone just needs to call because then I'm going to run the numbers and you go, I can do that. We have people on the other side. They're like, okay, homes in our neighborhood, 400,000. We'll be super happy. We found 3 or 4 of them. So we run through it and they go, oh my God, with 3.5% down, that's how much the payment is. We can't afford that. So it really, the big issue is clarity more so than talking about just where is the interest rate today? Where do I want the interest rate to be? Getting real clear. We talk about what does a pre-approval look like? What's the max you can qualify for? What does that monthly payment look like? How much money do you need? So when we have that conversation a little early, now we can go through and go, okay, at 5.5, this is what the payment looks like. At 6, this is what it looks like. Today at 6.5, this is what it looks like. A number of those people go, well, yeah, that's dumb. We're not going to wait for that. And some people go, I have to. That's where I have to be. And remember, these are all moving targets. Interest rates, a moving target. Your income and debt situation, a moving target. Home prices, a moving target. So we have to adjust as we go, watch and monitor, listen to this show, watch the news. Hopefully
not the news,
not the news, more of the data,
media.
not mainstream media, but more of the data coming out, financial news possibly. But even the Wall Street Journal has gone full New York Times on us here recently.
Well, nobody likes to hear this story repetitively, but it's a story I'm going to tell, and I'm going to be transparent. Last 2023, I bought a new house at the top of the market, right? That's what people said. Top of the market. I paid $1.5 million for that house, right? It was a big leap from where I came from in my other housing payment because I had an interest rate at 2.99%. I had owned that house since 2012. So a big jump in the mortgage payment, property taxes went up. It was was I comfortable with it? Yes. Did I like it? No. Here's the thing. Could I have waited? Could I have waited until rates came down a little bit? Sure. I could have waited for 5.5. That means I still would not own that home today. But here's the reality. A home just came up on the market. One across the street sold me for 1.6 already. Needs a full gut. My house is completely remodeled. One just came on the market, the same neighborhood, worse location at 1.68. So almost $200,000 more than I bought my house for 18 months ago. Now, that's not to say it's going to sell at that. It's not to say that I, time the market perfectly. I did what was right for me and my family at that time. Because here's the thing, even if prices go down to below where I bought that house for, it is what it is. Like, that's my payment. It's the new norm. That's what that's what I know I have to pay every single month. And fortunately, I've been in a position where I've been able to refinance, take advantage of 2 different half-point reductions in mortgage rate and save myself almost $900 over the course of this period of time. Why? Because I made the move when it was right for me, right? I didn't pay attention to those out there saying that mortgage rates were going to be at 5.5% or that the magic number is 5.8 or that, prices are going to crash. And I'm only saying this to tell you where the people that you're listening to, this is not bullshit. I am telling you exactly how we think. We're not making things up here to get you to go do things. It's the reality of how the people that are successful long-term in real estate think. They don't worry about what the house price is going to be tomorrow. They worry about where they're going, are they doing the right thing for their family, where they're going to be 5, 7, 10 years from now. And so with that thought, Josh, there's again this idea of the rate that people will accept. I told you, one of my mentors thinks that interest rate's around 5.8%. And the reason they believe that is because what they did is they looked at home builders during the course of high mortgage rates and where these builders needed to buy down rates in order to get new sales to basically pick up, right? There was a point where new sales were the majority of the market for a period of time because rates were so high. That tipping point was about 5.8. We're about a full percent from there as of today, Josh. So is waiting the right answer? Maybe, if your life isn't aligned with all of the things that we talked about.
Well, let me relate it back to the story that you just said. So for anyone listening at home, Jeb's not talking about FOMO, go out and do it, come hell or high water, buy the house. He's saying he ran the numbers for his household, didn't love them, but it was the right decision, and it's played out that way. It's cheaper than what he would have paid for it. He's ridden the interest rate down to where the market is at. So it is important to look at that and not say, I'm not buying because rates are where they're at today, because the numbers are telling us there is a significant amount of pent up demand at lower interest rates, not just you. So that's not to say we're not going back to COVID where we were getting 20, 25, 30% increases in homes year over year. But we're saying if rates are 7 or 8%, and we have the number here, Jeb, 7% of people say they're okay with rates at 8% or higher. And then they get 7%, it goes up to like 10%. So meaning 90% of people are either not doing anything because they're not comfortable with it, or at least uncomfortable with what they're doing. So we're below that. And we see every dip it takes, 6.75, 6.5, 6.25, 5.99. We've seen those all play out over the last 2-3 years. Mortgage applications, both for purchases and refinances, spike every time it happens. So affordability doesn't improve massively to a point at 5.5 where there's an influx of buyers and no one can get a home under contract. But the supply is not going to increase nearly as much as the demand. So there's a point there where if rates come down, we have a floor under the market. People hoping, expecting, dreaming of a crash that they're going to get in at a much lower price. If rates move lower, you have a floor under the market. Where you see the potential for corrections in prices is with those higher interest rates. If we have 7.5 for a year and a half, if we have 8% interest rates for 2 years, we've seen very, very low volume. We would see a situation where people just decide, hey, I'm not going to buy even though I could today because I'm not going to have an opportunity to refinance. Now we've seen this window where we've had a couple of windows in the last 2.5 years where people were able to refinance and benefit. So none of us have a crystal ball. It appears unlikely that we're going to have those high interest rates, but it's not a non-zero option there. It could happen. I don't know how quickly 5.5 is going to happen. For the remainder of this year, we're likely to be somewhere between where we are today. Maybe it could go back as high as 7, maybe as low as 6%. But the closer you get to that 6% level, the more buyers you're going to have out there. I have 2 buyers right here, one in San Diego, California, one on the other side of the country in Maryland. They both made offers this week, and multiple offers, multiple counter offers coming back. Now, is that in every price point? Is that in every market? No. But desirable entry-level homes, both of them bitchin' houses, nicely remodeled. So know what you're looking for. If you're that person who says, hey, I only have enough money for a down payment, I don't have enough to buy a fixer and renovate it, or I'm not handy, or I don't even know how that goes, I'm buying something turnkey. There's a very limited supply of those homes in the entry-level price points, and they're moving well at current rates. So at lower rates, it would likely only get worse. But again, none of this is to say to you, you should have a fear of missing out. It's saying, do your research, get super clear on this. Don't come up with a psychological idea in your head of this is the interest rate at which I will act. Get the numbers. I can run the numbers for you. We can say, hey, you're approved for 450 today. Here's 450 at today's rates. Here's 450 at 6.25. Here's 450 at 5.25. And if we got 5%, this is what it looks like. Now you're making educated decisions. And now you can say, okay, well, if I buy today at 6.75 and we get the 5.5, I could refinance and it goes here and I'm super comfortable. I'm like Jeb, I don't love 6.75, but I can deal with that. It would be nice to roll it to 6.25. It'd be nice to roll it to 5.5. But if you don't do that research and you're just guessing, assuming, then you really, what I'm taking from these surveys that we're looking through is they're very uneducated answers, because I see more people actually making the decisions than what people would imply. We've seen activity ramp up at rates well higher than what people are saying they would enter the market. So for me, the takeaway is not, hey, run out and buy a house today, but it's if you are psychologically in the market, if you're one of these people that say I'm 77% of the market is financially prepared to buy, 77% of buyers say they're financially ready, they're watching the market. So if you're one of those, don't just watch the market and watch Mortgage News Daily for interest rates. Talk to someone like me where you know what those numbers look like, where you're fully prepared.
Yeah. So if you want to be the educated home buyer, which is the podcast, reach out to our team, talk to Josh, let him run the numbers for you, and you can see whether or not it makes sense for you. And if it doesn't, that's okay. And if it does, then at least you can set a plan in action. Even if it's not, you can set that plan in action so that when that right threshold is there, you can take action. So I think two things are important to note. One is that every 1% interest rates drop adds about 4 million potential buyers to the market. Doesn't mean it adds 4 million people. It means there's 4 million people that could be buyers based on where rates are and affordability to become your competition in the market. That's real numbers. Also, I think there's a chance that both inventory and home sales can grow with slightly lower rates. I mean, I listened to it yesterday on Housing Wire, Logan talking about it, and there's a lot of sellers out there at the moment who are ready to jump ship on a lower interest rate. They have a lower interest rate now than what the market would otherwise give them. They've been in that house too long. They've outgrown it. It was the wrong house, whatever. So as interest rates trickle down, you're going to have more sellers come to the market. But remember, those sellers are also buyers. So there's competition there. So you can have both inventory and sales growing at the same time. And if you have that, you probably have, that floor in the market. But, again, affordability is a factor, Josh. It takes 79% more income today to buy the median price home than it did 5 years ago. Those are real numbers. And when people look at that and they don't truly understand housing, I can understand the idea that this can't continue forever. It's got to regress back to the mean. Home prices have to drop. We think it's crazy because you and I are in the industry, but when you remove yourself from this and you go, no, those are not irrational people. They're probably rational people, but they just don't understand the fundamentals that's been driving housing and why some markets like Southern California, the Northeast are still getting multiple offers, still selling above the asking price, while areas like South Florida, Texas, Louisiana, some of these other states, inventory's building. Homes aren't getting the appreciation. In fact, they've seen a decline in prices. So real estate being local, Josh, and affordability being the real problem, what's the solution?
That's the $24 million question, right? And that's why a lot of you are listening, and that's why a lot of you are thinking about buying a home and have not yet bought a home. It truly is affordability. We talk about the three elements there: wages, home prices, interest rates. Interest rates are higher than people are comfortable with. They're a little better than they were. We think they're going to continue trending in that direction. We don't know the pace or the depth of the interest rates they can get to. We talked about home prices. I don't think we have any real risk of double-digit home price appreciation, or even 5, 6, 7% home price appreciation. The numbers are telling us that it continues to moderate towards the 0 to 3.5, 4% range. So home prices, unlikely to dip, unlikely to go up. They're not going to be the solution, but they're already a problem. They're already at elevated levels and likely to remain so. Wages, we've seen wage growth is still above the long-term trend, but not much, and moderating back to that long-term trend. So I can tell you, the folks that reach out, that successfully buy, have controlled what they can control. They saved as much money as they could. They keep their debts under control. They advance in their career, and they get to a point where they say, "This is what I'm going to do." And that's these folks, the people in the market making that today, whether they're 32, 42, youngster 28 that's ahead of the game and jumping in. They've done it for the same reasons that I did it, that our parents did it, grandparents did it, because that's what people want. They want to own their home. They want to raise their family in a place of their own. There's, just that pride of ownership, of being able to do what you want to do. The downside is, hey, I'm responsible. There's no landlord to call, but 65% of American households at any given time choose to be homeowners. And that's not that psychological component of Americans is not going away. Affordability is likely to improve at a slow pace and not be where people are comfortable with it. COVID may have been the end of the era of people saying, yeah, I'm cool with it, because rates were so low, even though prices were going up, that we look at the affordability levels. Affordability levels were very reasonable. throughout the country. And that may end up being the end of it. I expect to moderate to it. I expect all of those things, a period of protracted sort of flatness in home prices relative to what we've seen, a correction in interest rates over time, and wages will continue to go up just slightly above the pace of inflation. And hopefully we get, again, we talk about Bill McBride over at Calculated Risk. He wrote this 7 Years in Purgatory. He wrote it about 2 years ago. And he was expecting 7 years of flattish prices while wages and interest rates correct to get affordability to a level where you could see a higher rate of appreciation. So the question you got to ask yourself is, do you want to wait another 5 years? Over that 5 years, even with 2% home price appreciation, that home's going to be 12, 13, 14% more expensive. That would now be equity that you have. You would have paid that home down 15%. So now instead of sitting on 30% equity after a 3% down, you're saying now I have to enter in. Yeah, I may have a lower interest rate. I may be making more money. Hopefully home prices aren't that much higher. But it comes back to you and knowing your situation. If you're listening to this show, you probably want to buy a home. Do the research, talk to someone, see the numbers. That does not mean, hey, I'm going out and writing an offer this weekend, but it means I'm serious at some point, at the earliest point as possible, when I'm comfortable with it and it's the right decision for me. I want to become a homeowner. So I'm doing the research to know what numbers look like to see what I am able to do.
Yeah, and I think there's some limiting beliefs out there that if that you believe these, you're not alone, and it's the idea that you're making the wrong decision, that it's too risky, that you might be buying the right house, and that's why it's important to do the homework up front, right? Not just jump into the market. Don't listen to a podcast or whatever. Listen to your Aunt Susie or whoever it is telling you need to go own a home and just go out and buy a house. It's talking to Josh, having the conversation, making sure you have people on your side that are truly on your side, right? Not Google searching mortgage guy to get pre-approved, but somebody that understands finances, somebody that owns real estate. And I'm not crapping on anybody out there, but if the person that's selling your house, doing your loan, doesn't have a loan, doesn't have real estate, or have never had either, I'm not saying that they're the wrong person, but come talk to somebody that can give you advice coming from experience. Like they've done it, they've been through the trenches, they understand it. Because again, it's all about having the right team on your side. And there's a reason that people look back. Josh, I'll tell you a really, really quick story. We talk about this all the time. Met a lady at an open house this past weekend. If I had to guess, she was probably between 85 and 90 years old, had 6 boys. That's doesn't really matter, not part of the equation. But I said, do you still own the house that you originally bought? And she said, yeah, that's the house I still live in. I said, what did you pay for it? $15,000. I said, I always hear this from other people, but I want to ask you, when you bought that house, were you scared to death about the payment every month? Were you scared that you weren't going to be able to make that payment? She goes, you have no idea. Me and my husband, it was $150 a month was the payment. And she goes, we had no idea how we were going to make it. And here she is today. The house was $15,000. I don't know where she lives, but in Huntington Beach, it's well into the millions. And it's not to say that you should stretch yourself and not know how you're going to make the payment, but time takes care of a lot of things. And so the earlier in your life you can buy a home, fix that mortgage payment, the better off you're going to be long-term, because you're going to make more money. That piece of your budget is going to become less and less. You're paying down the principal. You're getting the benefits of home ownership, all of those things. And I think that's why the podcast is here, Josh.
I'm going to double down on what you just said. My first house payment, Jeb, was $1,138. Pretty specific, right? I remember it was $1,138. Do you want to ask me of the 30 loans I've had in that time frame since then, how many I know the exact payment? None. The first one is unique, and it doesn't matter. At that time, Jeb, I was living at home with my dad. I had zero debt. I had saved up a good chunk of money. $1,138 a month was like a 10% debt to income ratio. It should have been nothing. And it's not. It's not for anyone. So no matter where you're at, no matter what you're thinking, you're going to feel that. That doesn't mean just ignore it. That doesn't mean that voice is always wrong. But we can talk to 50 different people through the years, different price points, different markets that they bought into. Every first-time buyer does feel that way.
No. So if we could be part of that process, you have questions, it's never too early to start. Make sure you use that link in the description of the video. Reach out to our team. We're happy to help you. If you found any value in today's episode, do us a favor, hit that thumbs up, subscribe to the channel for more information like this. Lastly, make sure you're buying right, borrowing smart, and building wealth. Until next time, adios.
Amigos.